Hi, I'm MGR Invests. Today we're going to be talking about a potentially undervalued stock which is listed on the London Stock Exchange. The stock we are analysing today is Lloyds Banking Group. Thank you to Kel Lee for suggesting a video on Lloyds. Please remember to comment on a stock that you would like to be covered in future videos, and I'll do my best to produce an analysis video on it. We are going to talk about the business model and potential growth areas before discussing the business fundamentals and analysing if it is a good buy or not. There are some key risks with Lloyds, so make sure you stick around to find out these. Lloyds is one of the UK's largest financial service organisations, with 30 million customers and 65,000 employees. The vision of Lloyds is to help Britain prosper through three main goals. One is to drive revenue growth and diversification. Two is to strengthen the cost and capital efficiency. And three is to maximise the potential of people, technology, and data. First, we'll discuss growth and diversification. To put it simply, Lloyds take deposited savings and invest this money for growth, hoping that there isn't a panic for withdrawals as people's savings are essentially tied up in investments and loans. They also hope that people or companies do not default on the loans, as this will cost Lloyds and is sometimes called bad debt. 66% of Lloyds' $3 billion strategic investment over the past 3 years is aligned with growing and diversifying revenue. According to the latest figures from UK Finance, Lloyds has the largest market share of UK mortgages, coming in at a staggering 18.1%, much higher than the second largest lender NatWest, who sit at 11.7%. Lloyds plan to drive growth and diversification through business acquisitions such as low-emission leasing company Tusker and car management app Cora. They also generate a lot of their profits by charging a higher interest percentage on what they lend out to the interest percentage that they offer to savers. This has been called profiteering, and they reported a pre-tax profit of 3.9 billion for the first 6 months of 2023. However, there is a golden point for this. When interest rates are 2 to 3%, Lloyds can generate very good returns as default rates are low. But when interest rates creep up, more people and companies default, meaning Lloyds pay out on impairment charges, meaning paying off this bad debt. There is growing pressure for leading banks like Lloyds to help people it's lending money to. An analysis from JP Morgan suggests declining amounts of loans issued by Lloyds will affect profits. This is both a positive and negative for Lloyds. As more people come out of fixed rates, they'll be on higher interest repayments to Lloyds. However, more people could default, affecting profits. Strategy 2 is to strengthen cost and capital efficiency. Lloyds emphasised the need for accelerated digitalisation and modernisation of technology. They state that since 2022, this has saved them 300 million in costs, and they've set a target of saving 500 million in costs by 2025. They state that they've invested in talent, skills, and capabilities of both staff and technology, which has led to ambitious targets in 2024 to 2026, with a cost-to-income ratio of less than 50%. This effectively means that they aim to spend less than 50p for every £1 generated, whilst maintaining their strong dividend policy. The final strategy is to maximise the potential of people, technology, and data. This ties into strategies 1 and 2, driving growth and diversification in revenue streams with cost-saving measures like increasing digitalisation to drive capital generation. By 2026, Lloyds expect a further 1.5 billion from strategic initiatives, less than 50% cost-to-income ratio, and over 200 basis point capital generation. So this all sounds okay from Lloyd's perspective, but where is the growth coming from? The first I always look at is the population. The UK, where Lloyds are heavily involved, is projected to increase to 74 million people by 2050, up from about 68 million today. Furthermore, the number of people taking out mortgages of 35 years or more has doubled since 2018. This is a stable revenue source for Lloyds, but only if we don't see another financial crisis with a large percentage of defaults. Having said this, Lloyds remain highly profitable, with dividends covered multiple times by earnings, but Lloyds is reliant on the strength of the UK economy. Rising interest rates, high inflation, and low economic growth pose a risk to Lloyds through mortgage and loan defaults. However, all this pessimism relates to the UK, not Lloyds, so let's have a look at the underlying business fundamentals. Lloyds currently trade at a PE ratio of 6. This is remarkably low and is half the average PE ratio of the FTSE 100. This is the type of PE ratio that you'd normally expect from a company with very little growth potential. Lloyds currently have a dividend yield of 6.4%, and they've recently announced a 15% increase in their interim dividend to 0.9p per share. Their net income was very high in 2021 and 2022, but decreased by approximately 5% in 2022 compared to the previous year. Their assets to liabilities have stayed around 1.06 for the past 4 years, and the PEGI ratio, a measure of whether a stock is overpriced or not based on the P ratio divided by the net income plus dividend yield, is currently 1.17. If this is under 1.00, as I've explained in previous videos, then it suggests that the stock is undervalued. So Lloyds may be slightly overvalued right now. That being said, if you're a believer in the UK economy, then the share price at a P ratio of 6 may be a steal going forwards. PwC suggests the UK will drop to the 10th largest economy by 2050 and will be overtaken by emerging markets like Indonesia and Mexico. I personally own a bit of Lloyds and will consistently top it up for the dividends. However, this one is a bit of a risky stock in the current climate, and I'd have it as a cautious buy right now. If you enjoyed this video, then please remember to comment and subscribe. I am a new channel, and the subscribers really help.